Hi, everyone. Welcome back to Wall Street Silver. Joining us is the founder and managing partner of Matterhorn Asset Management and Gold Switzerland based in Zurich, Egon von Greyerz. Egon, it's great to see you.
Good to be here, Ivan and Jim. I always enjoy our chats, so let's go.
Yeah, the audience really loves you. It's always, it's great to have you back. You said recently 2022 will be an epic risk year, will be an epic moment for investors. What are some problems you believe that you're causing this, or how big is this going to be?
Well, I'm a long-term thinker, and I started worrying about the world a long time ago, obviously, but specifically in early 2000s when we decided to go into gold and silver in a major way, because we felt that was the best way to preserve wealth. So we went in 2002, and gold was about 300, and silver was about $4, I think, roughly. And then, of course, then we had the first crisis, 2006-9. And the thing is, that was never solved. I mean, it was only solved by unlimited amounts of money being thrown at the problem. We were about a few minutes from collapse of the financial system. But central banks managed again, skillfully, I will have to say, to keep the bank standing. And now it's quite amazing that we have now seen these banks standing for 12, 13 years since this event. The problems are now much, much bigger, of course. So we had US debt around 50 trillion at that time. I'm talking about total US debt. And now we are approaching, approaching 90 trillion. And it's the same with central bank debt and the Fed debt and the deficits, etc. So the problems have now grown exponentially because if debt doubles, risk doesn't just double, it grows exponentially. On top of that, we're not seeing the figures, but I'm because they're not reported properly, but derivatives, I'm quite certain that is growing now, especially over-the-counter derivatives. They're growing also at a rate where I would be surprised if it's less than two quadrillion at this point. And this is where, as I wrote in my last article, this is where the mega manipulators come in. Federal banks are creating totally false markers because normally if you have high demand for credit, you would have high interest rates. Mm-hmm. But here we have high demand for credit because it's cheap, it's free. And interest rates are also staying at zero or just above zero. So therefore, it doesn't make sense. And things that don't make sense are not going to last. This has lasted a lot longer than anyone would have believed, and certainly longer than I ever could believe. Still, I think now everything is coming together. This inflation that we have been waiting for, because we know we've had massive asset inflation for a very long time now. But it hasn't, the way that inflation is calculated, it's not shown in consumer prices. Now that's coming because it's inevitable that with the amount of growth we've seen in money supply, in pure Austrian economic terms, inflation means increase in money supply, and we've seen exponential growth in money supply, and eventually that will show through in inflation, and that's what we're going to see in coming years. So as I said, coming back to the bond market is not going to, yields are not going to stay at 0%. We've seen the 10-year going up already, mm-hmm. and that's just the beginning. I think we're going to see rates. I lived through the 1970s. I lived in the UK at the time, and as I stressed many times, my first mortgage was 21% in 74. And how many people do you think can today cope with 21% interest rate on a mortgage? Not many.
Yeah, not many at all. And that's the big question. In recent, I guess in the past 2 weeks, they've been hinting that the European Central Bank may actually raise rates, which is the first time in forever that they've even talked about that in Europe. what would you, and you're based in Switzerland, so you're probably more in touch with what's going on there than most of our audiences. But would you expect a lot of, we all remember the Greek debt crisis from 2011 or 12, I believe it was. A lot of those countries can't exist unless the European Central Bank keeps buying their debt and keeps their rates artificially low at 1%. I mean, no private investor is going to invest in Italian or Greek debt at 1 or 2%, right? So what happens if the European Central Bank is forced also to reduce bond burst purchases and actually raise rates? Would you anticipate another debt crisis in the southern periphery of Europe?
Well, a debt crisis is guaranteed. It's only a question of when. Central banks are between a rock and a hard place. They don't know which way to turn. Of course, they should. With these inflation rates we're seeing now, and with these enormously big gap between inflation and interest rates, so we get this very big number of negative real rates, which, as we both all know, is really wonderful for precious metals investors. And to have this gap now 5% or more, and if you take the real inflation figures, which are certainly a lot higher than 7%, then now you have the gap is probably 7-8%, the negative real rate. So therefore, and I've always said that in the end, you have bonds issued by central banks and governments around the world. Most of them are bankrupt. Most of them can never repay the debt. Most of them can only continue to function by issuing more fake money in the form of debt that will never be repaid. And the only way they can keep on doing this is, from their point of view, is to have zero interest rates. But there will be a point when borrowers or investors in these bonds will say, "This is it. I'm not going to give bankrupt governments money at between zero or even negative, in some cases zero, and let's say 2% or in the form of the 10-year in the US or just under. I'm not going to give you any money. You're offered risk and you're not paying me any return on that risk. Why should I give you any money?" And therefore, I think that they always believe that the long end of the debt market will be the one which will suffer first, and we've already seen the start of that, which means that long rates will start going up, and they are already.
Yeah.
And then after the long rates will eventually pull the short rates up. And that's coming. It's only a matter of time. Coming back to Europe and Southern Europe, none of these countries can afford it. Greece, Italy, Spain, France, etc. Germany can afford it for a while, but that's about the only country. So this is why we are going to have a debt crisis. Interest rates have turned. This cycle was slightly longer than the last cycle, which was 35 years, and this one was a few years longer. But nevertheless, we turned. We are going to see rates going up now for decades, most probably. It's never a straight line, and this will be an enormous fight between the market and the central banks. I think the central banks will lose in the end, because they as I said, the long end of the market will start determining what rates will be. And the short end will follow, and the central banks will not be able to control these rates anymore.
It's almost like a game of chicken, right? To see who blinks first. It's the Fed will keep raising rates slowly or quickly. We'll see. I think the Fed really believes their credibility is on the line as to whether or not. I think they have to raise rates. They've talked about it so much, of course. It's all priced in now.
Well, we all know that they are clueless. We all know that they never anticipate anything, and we know that they're always behind the curve. Now, the problem is the curve is telling them in no uncertain terms that we are in a period of high inflation and we need to have higher interest rates. Because, just think about the bond market which start to fall. I mean, that's the biggest bubble in ever, the bond market. And then combine that with the stock market, and they can't support the stock market more, because anyway, nobody's going to believe in the next round of fake money, maybe for a day or two, but then nobody's going to believe that this is money anymore. And it's amazing that the world has believed it for such a long time. We know why, because they all have, everybody who's in financial market has a vested interest to play the game, the fake game, and of course, the ones who have money, as we know, have made absolute fortunes in the last few years. I mean, I was showing in my last article that how Warren Buffett in 1994, I think it was the richest man in the US with $8 billion. $8 billion. Now, new companies have been created since then, 5, 6, 7 companies. Each one of the owners of these companies is worth 100 million or 200 million, 200 billion, $200 billion.
Yeah, this is a tweet you just made the other day. What you just mentioned, everyone, Egon is on Twitter. His account is @Gold Switzerland, great account to follow. But what he was just discussing, I actually saw him tweet the other day about that fact with Warren Buffett, how his change in wealth and the companies that have come along in the past 30 years. It's a good point to make. The Fed has to fight inflation right now, or pretend they're going to fight it. But at some point, they're going to have to pivot back to easy money because the pain is so great. Do you have in your mind a point where that happens, or do you think that happens?
Well, I think we are giving these central banks too much credit. They've had such an easy time for many years now in totally controlling money supply and interest rates. Sure, people say governments can never go bankrupt, but the printing unlimited amounts of money is a technical bankruptcy, whatever else they want to call it.
Default by another name,
and therefore they're already bankrupt now. And the only way they know how to do it is just to crank up the printing presses. That's not a real economy. We are in a fake economy. It is wizardry by the central banks. It's only because the kid investors that are following the wizard, they love to hear and love to see what they do. But at some point, they will be very disappointed when the whole thing collapses, and it will do.
You mentioned earlier the derivatives, however many quadrillion in derivative, there's credit default swaps on every imaginable piece of debt out there, which leads to counterparty risk. And who was it? It was Warren Buffett who called this weapons of mass financial destruction. There's counterparty risk. There's someone on the other side of every one of these derivative bets. And as interest rates are forced up, as you said they're likely to be, someone's going to be on the losing end with tons of leverage too, of all of these derivative plays. Are you anticipating lots of failures in hedge funds and banks because of this? Is this
absolutely? As you rightly say, every single derivative has an interest rate element in it, and these derivatives cannot take interest rate going from 0% to 5% to 10%, so that's one point. The other one is, as to say, the counterparty risk. As you know, that all banks, finance institutions, etc., net their gross risk down to nothing by offsetting all of these instruments. But as we know, for example, at the end of the 90s, in connection with long-term capital management, all of a sudden there is no matching. The matching doesn't work. And therefore, gross risk remains gross, and therefore, there will be no one standing on the other side of the transaction to pay up. 4 quadrillion, that's just unreal. And of course, initially, central banks will just start printing more money to try to save the commercial banks. But of course, that will that will not have any effect after a while, and we will run into, I think, still we are going to have at some point hyperinflation.
Yeah.
It will be inevitable. Yeah, absolutely. With the amount of money outstanding, if you include derivatives, then they will have to print unlimited amounts of money, but it will have no effect, and we will have the typical hyperinflation, which normally happens at the end of debt bubbles like the one we've seen now.
Yeah, Egon, what's your timeline for this?
Yeah, that's kind of wide open there.
I know.
I'll tell
Yeah,
you tomorrow.
Next Tuesday,
Tomorrow.
next Tuesday, Egon, right?
Tomorrow. Now, I've learned one thing because we live today, because we see all the risks today, and I saw them a long time ago emerging. We believe it's going to happen just because we see them. But I've learned one thing, which is to have patience. Things don't always happen exactly when you expect them to. So the most important thing is from an investor's point of view is identify the risk. The risk is there, and then you cover that risk either by getting out of the instrument that are at risk, or by hedging against it by, for example, buying physical precious metals and keeping them out of this fragile financial system. So that's what you do, and then you just have patience. So you don't worry about when it's going to happen. You just take whatever measures you need to take, and then you just sit tight and wait and don't worry about it. Whatever happens is going to happen. As I said, I would be surprised if this all doesn't start in 2022. Now, it's not going to happen overnight, but the crashes sometimes happen very quickly, or they can be painful and take a long time, and everybody and every decline, people buy the dips, and then they're going to go, market goes up for a little while and it goes down again, and they buy again and it goes down again. So it could be a long, painful drop here.
We're all surprised at how long bubbles can go, far longer than anyone could anticipate. And your comments about gold and silver being the place, perhaps we are too early. A lot of us are investing in physical gold and silver right now in anticipation of these events that you've described. But something Willem Middelkoop said recently in an interview we had with him, if you're not in it, once it happens, it's almost too late, because the retail market, the access to gold and silver bullion, it can empty instantly over a weekend. Once it becomes clear to everyone and they're talking about it, it's too late. You've got to be in it to win it, as Willem says. Would you anticipate that also, that when the crisis is already visible to people, it's already too late to protect yourself?
No one has ever gone bankrupt by taking profit too early. But sadly, the greed today means that most people won't. But that's what they should think about. At these extremes of markets, you take profit early. It doesn't matter if the market doubles from here, because it will go down by 90% or more in real terms thereafter. And no one has ever gone bankrupt either by buying the fire insurance too early, because you know that the day after the fire, you can't buy it. And it's the same here with the precious metals. Funnily enough, one of the major gold refiners here in Switzerland just announced major increases in the prices of the metals, in the markups, spreads of the metals. We were surprised. This has not been in general across the board yet, but among others. But are they seeing? They haven't told us, but are they seeing shortages coming? Mm-hmm. And are they seeing, as you say, this high demand, which we are expecting? We are, of course, we know that from the 0.5% of world financial assets today, the gold will be 1% or 2% in the next few years, and there won't be enough gold in the world to satisfy that. The only way you can satisfy it is by higher prices. Mm-hmm. And that's going to happen, absolutely guaranteed. So yes, that will come. Some people will say, "Oh, he's just wishing." that it's going to happen. He's dreaming. All the central banks and all the BIS and William Banks have always managed to manipulate it. Again, false markets can last for a while, but they don't last forever. In the end, supply and demand of the real underlying product will prevail, and we're going to see that, whether it's tomorrow or in a year's time or whatever. I don't care. We are ready. You are ready. We are ready, and that's the most important thing now. You can never be too early in a market that it's so exaggerated and in a world economy which is so bankrupt as it is. You can never be too early in protecting yourself.
Yeah. Well, our audience is on the same page. You don't have to worry about them. Most of them are they are completely in tune with everything that you're saying right
now.
Well,
that's wonderful on the one hand. I know that it's always nice to talk to friends and to preach to the converted. Of course it is. And that feels very good. At the same time, I wish that you and we could reach people outside our own group of people, so that we could help more people. I mean, that's our aim with our business, to help as many as we can. But sadly, they don't want to be helped now, because they want to stick to what they have followed for such a long time successfully, has to be added. That they find it hard to change tack.
Well, we're doing our part. We're up to 181,000 members on Wall Street Silver, and we're sharing the message.
Fantastic.
It's growing
Fantastic.
steadily.
Yeah, that's great. I mean, that's wonderful. That's wonderful. Keep on sharing it, and you will have, eventually you'll have millions of people following you,
and then it'll be too late. We'll have $100 silver and $5,000.
Yeah, but I said a long time ago that I don't care where silver and gold will go. It doesn't really matter to me. For me, the primary function of these metals is wealth protection. But I know also they will actually represent massive wealth enhancement also, because of all the facts that we have just discussed. But when we went into gold 2002, $300, I said that I expect gold in today's price to reach at least $10,000. It's not a forecast, but it's just, I think that's the minimum I would expect. And of course, I would expect also the ratio to, let's say the ratio goes down to 15, and then you get silver 666. I know some people don't like 666, but actually that's in the Bible. It's a historical figure for actually what's his name, King Solomon. He got 666. What were they called? The measure he got every year. But anyway, that's not impossible for silver at all to get the 600. I'm not trying to be sensational again. I'm not counting on that. All I'm saying is by pure extrapolation, and that's only 10,000 gold. I mean, I would be surprised if gold only reaches 10,000, and that the ratio goes back to, you might go under 15. So that's in the realms of possibility, but I'm not trying to be sensational anyway. I'm just saying that it wouldn't surprise me that happened.
Mm-hmm. We had an interview with a fellow named Dave Kranzler. He's one of the newsletter journal writers, and he said at some point in this process, we'll no longer be measuring gold and silver in dollars or euros. No, so absolutely. Any price, the crazy prices that people put out there as projections, if this really gets bad, anything's on the table in terms of number, and dollars and euros almost becomes meaningless at some point.
Yeah. No, I'm talking in today's money when I mention these figures. Forget hyperinflation, all bets are off. Then the only thing is to talk about gold and silver in ounces or grams, nothing else. That's the only thing that counts. You can't to talk about them in worthless fiat money. I mean, is meaningless. Of course, totally meaningless. All it means is that the people who stayed in having the cash instead or normal investment, they will lose all of that money. That's when it's important. They will lose 100 trillion against if they'd had gold. Think about the people in Venezuela. If they'd gone into gold, in 2000, they would have all had food on the table today,
Yeah.
even if they only bought for a few dollars. That's really what people should think about.
Well, Egon, we want to thank you very much for giving us so much of your time today. We really appreciate it. The audience loves you, and we'd love to talk to you again in about 2 or 3 months as the market develops this year.
All right. Well, always fun to talk to you, and a pleasure. So thanks very much, and see you soon again, I hope.